in this module, C module, basically, we have a lot of questions they ask, practical questions they can ask from this module. Okay. And also some theory questions also they are going to ask. Okay. So this model is not very tough. Okay. Like you can just focus on the concepts, the numericals, and little bit theory, which you have to study. So easily you can score very good marks in this model. Okay. So in this model, you have topics like financial mathematics and business mathematics combination topics you are. Okay. So first you are having the basics of financial management, and then you are having different topics which we have to study. So I will just do the topics in the way it should be. Okay. So then we have to study about time value of money. Then we have to study about valuation of bond. Then we have to study about capital budgeting, cost of capital, okay, working capital, then forex, leasing and hire purchase is there, or leasing finance is there. Okay, so these are the topics which we have to discuss and in detail. Okay, so today first we'll start with the basics of financial management, or the fundamentals of financial management we'll be discussing now, and then we'll move for time value of money. Okay, so now if we talk about the financial management topic, okay, if we look about financial management, so basically we know that financial management, right? So if we talk about that in business, everything is about finance, right? So it's very important that uh, all the things what we deal in business is deals with finance, right? So it's very important that how you are getting the funds and how you are utilizing or how you are allocating the funds. It's very important that you are using the funds in the best possible way what you need, right? Correct? Because obviously, if we not use the funds in the best possible way, right? So obviously, you will not get the profit first thing. Second thing, you will be having a lot of losses you will be facing in the business, and then slowly you will not be able to survive for a longer time period, right? So this is what exactly we do in basics of financial management or fundamentals of financial management. So here we'll be looking other topics. I'll just show the PPT. You are able to see my screen?
Yes, sir.
Yes, sir.
So this is the basic thing that what I told, that if you look the financial management, so basically we do what are the sources from where we get the funds and how we do the allocations or other activities of finance, how we do, right? So this is what we do in financial management. So basically planning or raising the funds, controlling, administrating the funds. So this is what basically you do in financial management. Okay. So also it's very important that you choose the best way to, what are the sources to raise the funds. So that is very, very important, and how you are going to achieve your goals with the help of all this financial management. So this is what you are going to do in financial management. So if we look about objective of financial management, so basically two primary goals or two primary objectives will be there of financial management. One, or any business if you talk about, one is to maximize the profit, right? So this is very important whenever you do any investment, or whenever you are getting any funds, or when you are raising any funds. So you always see that how we are using that funds, or normally in your day-to-day life also, if you borrow funds or you take any loan, you always see, that which loan is giving you lesser interest, right? You don't have to pay higher interest. So you always compare, right? And then you choose, isn't it? So similar way here also, you are going to see that what are the combinations of different sources we are going to use it, so that our earning should keep on increasing. Okay, earning should be higher, it should not be lesser. That is what the basic motive of any stakeholder in the business, right? A stakeholder we say means any person who directly or indirectly attached with or related with the business. Okay, so first motive will be profit maximization. So we have to maximize our profit. Second thing is wealth maximization. So how we can maximize our wealth, right? So if we talk about wealth means the anything which increases your wealth means like basically we talk about the assets, right? So anything, so how we can maximize our assets, the cash flow, how we can minimize our risk, right? How our share value or share prices or value creation is very, very important. So these all are related to the wealth maximization. So these are the basic two primary goals of financial management we are having. Okay, then it comes about financial decision. Okay, so apart from the goal, like obviously whatever decision you are making, so what are the different kinds of financial decision we are going to make in financial management? Okay, so one thing is very important, the role of the financial manager. So obviously key decision maker will be your financial management or top management will be there who will be deciding that, okay, what goal to choose, what goal to choose, and what should be the sources of funds, which source should go or further we should proceed with, right? So all this will be done by the key decision maker. That will be your either financial manager and the top management will be there. Okay. Then, if you look about core responsibilities of financial managers, so determining financial need, so you have to see what is the need, right? So it's very important that if you need funds of 1 lakh, obviously you are not going to borrow funds 5 lakhs or 10 lakhs, right? So you have to see whether the funds required for short term or long term, how much funds needed, right? So all those things, the financial manager is going to determine. Identifying funding sources, what all sources options are available for you, right? Whether you can raise funds through equity capital, preference shares, or debentures, or you can just borrow funds from bank or any financial institutions, or maybe you can borrow funds from your relatives, friends, family members. So all those funding sources you have to identify. Then you have to do the analysis. So you have to see that, okay, based on whatever the financial data you are having, you have to analyze all and you have to choose the best one, best possible way. And then capital structure optimization, right? So you have to see that what should be the correct uh, capital structure you will be having that always increases your earning per share, right? So always any shareholders or investors, what they expect, they want that their earnings should increase, right? So you have to choose such kind of capital structure only. Like obviously you need funds a lot of time, right? So obviously you cannot depend on only one source. So either you can raise through debt, equity, preference. We'll discuss that later. What that is. Okay, so you have to combine it and choose the best one. Okay, so capital structure optimization you have to do. Okay, additional financial management functions can be cost, volume, profit analysis, like we say break-even point, marginal costing, right? So those things you study in module D, I think, right? Yeah. So cost, volume, profit analysis you do, you find out what is my break-even point. I should produce more, or I should produce lesser than my break-even point. So that you do. Profit planning and control you do, right? That how much profit margin should be kept. Fixed asset management, where we are investing in assets or how we are, what are fixed assets, whether we should invest in or we should hold it or working capital needed. So it depends. Then capital budgeting is there. So capital budgeting is related to your decision making related to investment. Okay, so where exactly we have to invest. So there we have to make decision that which investment method or which project is better, that we can find out in capital budget. Okay. So certain fund till here, any doubt you are having? Till here, any doubt? Any question? You can unmute yourself. I have not muted you. These are the basic concepts. Yeah, tell me. So then certain fundamental principles of finance we are having, so that we can just look at. So one is like time value of money. So on these principles, a lot of concepts are there. So that we are going to study as one chapter or one topic where we discuss that how the money value we are going to find out, or how money value or money worth we are going to find out based on the time. So how the time moves, the money value is also going to choose. So there we study about present value, future value, annuities. So this is one principle of finance we are having. So obviously, if we invest and certain rate of interest will be there, money will grow, money value will change. So that is one principle we are having. Then higher risk, higher potential return. So this is also, you will be knowing that when you are ready to take higher risk, obviously your return will also be higher. So such securities or such kind of stocks or bonds or such kind of derivatives you are having. So such kind of securities you are having or investment avenues or methods you are having, if you invest, if you take higher risk, your return will also be higher. So it depends what kind of risk you want to take. Moderate means return will be also moderate. Less risk means return will also be less, right? Either fixed deposit or not. So this is also one principle. So risk return trade-off will be there. So if you take higher risk, higher return you can expect. Okay. Then we talk about various diversification. So we have different, a lot of portfolio is there, diversified portfolio is there where you can go for the investment. So either it's about stocks or it's bonds or liquid asset. You can working capital and all it comes. Real estate investments, you can invest in commodities, and also various avenues are there where you can do the investment. So you can diversify your portfolio, right? Because normally we say na, that rather than keeping eggs in one basket, keeps in different basket, right? So you should not put all eggs in one basket. So what is the reason? What is the reason of this principle? Because if you invest all your money in one securities, maybe if that is in loss, you will face huge loss. But if you will divide it, if you diversified it, maybe somewhere it will balance it. So maybe one place you are facing loss, but other place in other securities you'll be getting benefit or gain. So it will balance it, right? So that is the reason we say that always put all eggs in, rather than putting all eggs in one basket, put eggs in different baskets. So this is also one principle which we follow. Okay. Then arbitrage and market efficiency is there. So arbitrage means how the current this profit or gain we are going to get based on the fluctuation of currency. So normally in forex market, what happens? The currency valuation will be there, right? So like every country is having their own currency. And when we value it, like $1, we have to pay 80 rupees, 89 rupees, depends on demand and supply. So when we value it, so obviously the fluctuation will be there in currency. So maybe in one market, if I convert Indian rupees into dollar, or maybe Indian rupees into euro and then euro into dollar. So maybe somewhere I'll be getting, by due to that conversion of currencies, I'll be getting somewhere profit or gain. That is what we call as arbitrage. So that is also one principle. And efficient market hypothesis is there, or efficient market is there. So efficient market means we, in this market, we try that even we take average return and or not very high return, we try to get higher profit. Like different models we are having, Markowitz or capital asset pricing model, and also different models are there. So these are the principles we are having. Okay. Then certain essential concepts are there. So you will be knowing about one we call as stocks, okay, bonds. Okay. So here I'll just tell you, uh, we have different types of sources of funds, right? So either we say equity shares, or we say preference shares, or we say debentures. So these three are main. So equity shares means, suppose the company wants to raise funds through the public. Okay. So what the company will do, company will issue equity shares, and the public investors will purchase those equity shares and invest in the company, right? So equity shareholders will be the owner of the company. Okay. They'll be having voting rights. Okay. So they'll be like owner of the company. They'll be having voting rights. So equity share also one of the method to raise the funds. Also, we have preference shares. So preference share also one of the method to raise the funds. So preference shares means here, and I forgot to tell you, the equity shares, shareholders are going to get dividend. Okay, shareholders are going to get dividend when company is making profit. Okay, when company is making profit, then only dividend will be paid, because they're like owners, no? So when owners will take their cut or profit or their salary or their whatever is. Uh, so when they are making profit, right? So equity shareholders or preference shareholders, we pay dividend when the company is making profit. If company is not making profit, we are not liable to pay. We cannot pay. So when loss will be there. Okay. The difference between preference shares and equity share, like preference shareholders will be given preference, as name says preference. So preference in paying the dividend. Okay. And also when we are winding up the company, when we are closing the company, right? So we have to return back the amount, right? So we obviously we have to protect the interest of the investor. So we have to return. So first preference will be given to the preference shareholders. Okay. And for both, we are going to pay the dividend. Difference is here voting rights will be there. Here no voting rights. Okay. Only preference benefit is there while paying the dividend and also while winding up the company. Is it clear? Is it clear? Then we have debentures. So debenture is basically a type of loan or also it's similar to bonds. Okay. So normally in debenture or interest, what happens? Interest we pay in loan. Normally it's a type of loan. Either you say term loan or you say loan or you say debenture or bond is a similar thing. Only difference in debenture and bond is debenture will be like perpetuity, means perpetual, lifelong till the company is there. Bonds will be having maturity period. So what is the similarity both is having, or what exactly that's it? That is means in case of debentures and all, the company is promising to the investor to pay a fixed amount of interest every year without fail. Okay. Okay. So a fixed amount of interest we are going to pay to the investor every year without fail. So here in case of debenture, it's not like when you make profit or loss, you have to pay. No, either you make profit or you loss, doesn't matter. You have to pay the fixed amount of interest. Take for example, suppose I take any loan from your bank and suppose I lost my job, or maybe I'm not working, or I'm not getting any money saved. Can I say your bank that, okay, please leave the interest? Bank will agree. So that is what happens, the difference between equity and debentures and all, that in case of debenture, we have to pay fixed amount of interest every year without fail. So if we say 2%, 5%, 18%, whatever we have said, or in the promissory note or in the structure, so bond or so whatever we have promised, that amount we have to pay every year without fail. Okay. So that is we call as debentures. So these are the different types of sources you are having. This is not required, not required. Okay. Okay. So this is what you are going to study in detail in further topics like cost of debt, like cost of equity, capital budgeting, and weighted average cost of capital, right? So later we have to see that to procure that funds, how much the cost will incur, what is the interest we are going to pay, or how much interest we have to pay, that we are going to learn in cost of capital chapter. And capital budgeting is there. So overall, if this is related to investment decision, and weighted average cost of capital means if average I take of cost of debt, cost of equity, cost of preference, if that average we take, that is called as weighted average cost of capital. Okay. So these are the different simple topics, or just you are having the fundamentals of finance here. And also we have to see ethical financial management. We have to see that we disclose correct accounts and all, right, to the government or to the stakeholders, right? So transparency in reporting is important. Accountability to stakeholders is important. Fair business practice is important. Compliance with regulations, right? Then CSR. Nowadays you would have heard about CSR or ESG. Have you heard about it?
True, sir.
CSR, or nowadays we have ESG also, right?
Oh,
So corporate social responsibility or environmental social governance. This is what we call as, right? So nowadays the listed companies, which all listed companies are there? So 2% of their PAT, right? They have to put in CSR activities, isn't it? So 2% of your PAT, you have to, like profit after tax, you have to put in the CSR activities. So that is mandatory for the listed companies, right? So these all things we have to look in the fundamentals of financial management. So is it clear? Okay. Now, what we are going to look. So this is just basics or fundamentals. You can read it theory. So now, the first topic which we are going to start is time value of money. So I think here in the basics, I don't think any doubt will be there. Anybody is having doubt in the basics? Okay. So next topic now, what we'll start is time value of money. So this is very, very important topic, very, very important concept, which you have to remember because definitely you get few problems in exam, right? Correct? In time or related to time value of money. So if we talk about time value of money, so here what exactly we try to learn here, we try to study here that rupee 1 today will be having more worth or more value than tomorrow. So what exactly I'm trying to say here? So take for example, if I say that 10,000 rupees I'm giving you right now, okay, 10,000 rupees I'm giving you right now, or 10,000 rupees I'm giving you next year. Which one you are going to prefer? So 10,000 you want now. Okay, why you will take now only, not next year? Right. So one is inflation. Okay. Second thing, if this 10,000 rupees you invest somewhere, if you put this 10,000 rupees somewhere, by next year it can be 10,000, maybe 300, 10,500, 10,800, 11,000, 12,000, 15,000, something like that, isn't it? So obviously the money what you are having now and also inflation is there. So inflation will increase means again that 10,000 will be having lesser value, right? So right now what you are having will be more worth. And second thing or third thing you can say is uncertainty. Is there any guarantee that 10,000 rupees you are going to get next year? Is there any guarantee? So don't know. No? Anything can happen. Maybe that time I'll not be having money. I cannot pay you. I cannot give you. Right? So uncertainty will also be there. So this is the basic fundamental concept of time value of money we are having. So money, what you are having right now, 1 rupees or 10,000 rupees or 1,000 rupees, you are having more value in comparison with tomorrow or next year, what you are having, right? So basically, if time value of money concept you look, okay. So one is earning potential, second one is inflation, and third is opportunity cost will be there, right? So these are the basic terms we are having if we talk about the money value. So here, what comes into the picture? So first thing we are going to talk about future value and then present value and then annuity we'll talk about. Okay. So this is how we are going to move further. Okay. So if we talk about future value, so earlier you remember, like just a second. Now, earlier you were having two concepts, one we call as simple interest and one we call as compound interest. Do you remember? So if I say simple interest means, for example, if I say 100 rupees you are investing and rate of interest is 10%. So by next year you will get 110 rupees, right? Correct. So interest
Yes, sir.
remain 10 rupees and after that also next year interest remain 10 rupees, isn't it? Correct. So in simple interest, the interest remain fixed whatever year you are calculating, right? But in case of compound interest, what happened? Compound interest, what happens? Suppose this year 100, 10% interest rate means by next year it will be 110 rupees, right? But again, after that you are calculating 10% means that 10% will be calculated on, correct, not on 100 rupees. So it will be added. So your principal plus interest will be added and then it will be compounded, right? So it will be calculated and it will become 11 rupees. So that is how the compounding works, right? So this is what nowadays we don't say as compound interest, we say as future value. We say as future value. Like say, for example, earlier, if I say in your childhood, maybe you would have studied that if we have to calculate amount means P into 1 plus R by 100 to the power T, something like that you have studied, correct? So
Yes, sir.
nowadays we don't use this formula. Instead of that, we say that, okay, let's calculate future value, because future value is also amount, right? Any amount you calculate in future, either tomorrow, day after tomorrow, 10 days, 15 days, 20 days, 1 month, 10 months, 10 years, 5 years. So all are your future value, right? All is your amount only, and all are your future value, right? So that is what nowadays we say as future value concept. Okay. And the formula also you will see as same. Like you will see future value formula we write as, instead of principal, we say as present value, means the amount which you have invested in the beginning. And instead of writing 1 by R by 100, we just write it R and power n. Either we write time as n or time as t. So we don't write R by 100 directly. We can convert into decimal, because earlier what was happening, the calculators were not allowed, or everybody were not having calculator, right? So we write R by 100 and then we do calculation. So reducing and doing will be easier. But nowadays, most of the time we are using calculator, right? Everybody can afford calculator. Everybody is having calculator, right? So the formula also has been modernified. So instead of telling R by 100, we say R. So if somewhere rate is 10%, I will write as 0.1, means 10 by 100. Correct? 20% means 0.2 I can write it. Is it clear? So
Yes,
same
sir.
formula we are writing like this. Future value is equal to, means amount is equal to P. Instead of P, we have present value into 1 plus R to the power n. N you write or T you write, it's same thing. Okay.
Okay.
Now, how to identify in any question that you will remember, how to identify in any question that they're asking to calculate future value. Okay. So in any question, if they say, find the amount we should invest after, at the end, hence. So these all words talks about future or present, right? Somewhere they say find the amount at the end of 3 years, find the amount after 3 years. Hence 3 years means all I'm asking the amount in the future. So in any question where they say like this, find the amount at the end of 3 years, after 3 years, hence 3 years. So that is your future value. Is it clear? How we can solve it, how we can calculate it. So you have to look in the question that what is the present value, what is the rate, and what is the, okay. So take for example, suppose I say that maybe we have invested 1,000 rupees, or present value is 1,000 rupees, rate is 10%. Can you find out the future value or
In
amount at the end of 3 years? N is 3. So obviously I'm asking to calculate future value, right? So we can just directly put all the values in the formula. So future value is equal to 10%. I can write as 0.1 to the power 3. So what is the answer you will get? So this is what you are getting. Okay. So one thing you can keep in mind, that if this calculation, right? So this is only main. So suppose 1.1 to the power 3 is there. Maybe easily you have calculated by multiplying 1.1 into 1.1 into 1.1. Okay. But if suppose the power is more, like 1.1 to the power 20, something like that is there, then how you are going to calculate, right? So I hope everybody is having normal calculator. If somebody is not having, they can download app also, like Citizen Calculator in their mobile. Like this app will be. So in your mobile also you can download Citizen Calculator like app, it will give you. So how you can calculate, right? So always first what you do, that whatever power we have to find out, always first multiply 2 times. So 1.1 into 1.1, how much it is giving? So all are getting 1.21, and here you will see left hand side top as 0.3. You can see like this 0.3. So now you can observe here that you have multiplied only 2 times, 1.1 into 1.1. You have multiplied 2 times, but it is showing 3, means it shows 1 extra, isn't it? This is showing 3, you have multiplied 2 times, but it is showing as 3, means it shows 1 extra, right? So if you want 20 means, here how much will show? 1 extra, 21, right? So what you can do, you just keep on pressing is equal to button. No need to do anything. Keep on pressing is equal to button. When you see 21 here, stop it. That is only answer for 1.1 to the power 20. 6.727. Anybody is having doubt? You want me to repeat again? Okay. First multiply always 2 times. Any number, whatever power, 5 times, 6 times, 10 times, 20 times. First you multiply 1.1 into 1.1 and press is equal to button like 1.1 into 1.1. So you just do, it will show 1.21. Then if you want 20 means you should stop for 21. So then keep on pressing is equal to button. Keep on pressing. When it shows 21, stop it. So one time more, 20 na? So one time more. When it shows 21, stop it. So 6.727 you will be getting. Is it clear? Okay. And then one more thing you can remember, you got 6.727,499 like that, right? So whenever you are taking the value for multiplication, don't round it or don't take only decimal up to two digits or 1 digit. Okay. So you take after decimal, at least try to take 5 digits or take full value. Don't round it. Like somebody will take 6.72, or maybe somebody will take 6.3, or somebody will take 6.28, something like that, or don't round it, right? So if you want, anyhow, you are having calculator. So if you want accurate answer, take full value. If you want approx answer means, okay, you are thinking that, oh, full value, how to take means. So at least after, so keep in mind that at least 5 digits after decimal you take or take full value. Okay, don't round it because here though maybe it's 1000 rupees, but somewhere you get higher value. Like somewhere the value is like 1 lakhs, 2 lakhs, 5 lakhs, 10 lakhs, then huge difference will come. So sometimes maybe chances will be there. You would have choose wrong option. Okay, so take full value or after decimal, at least 5 digits you take.